All right, so here we are today with another episode of the Assets and Algorithm podcast, where we talk about the intersection of real estate and technology. Today, I have Stewart Heath of Harvard Grace, and thank you for joining me, Stewart.
Thank you for having me. It's always an honor.
I love that. I love that. So, I'd like to jump right into it. Ask you if you could share a little bit about your role and how it fits into the bigger picture at Harvard Grace.
Yeah. Well, I am the CEO and founder of Harvard Grace and Harvard Grace Capital. So the vision is mine. I'm probably actually am also the COO, so very active in the day to day. Harvard Grace Capital is our main thrust these days. It's been active since late 2021, and since then we have acquired 9 separate properties, just shy of $35 million of assets under management and about 11.5 million of equity under management. So day to day, we manage all these properties as well. I do have a property manager, and we're bringing on a couple more people this year as well. So that's pretty much my role, going out and picking out dirt to buy and looking for good tenants and good cash flowing properties.
Awesome. It sounds like you guys are doing really well over there at Harvard Grace. Congratulations on your success.
Yeah.
I want to ask you a little bit about some of the major shifts that you're seeing in the industry right now. Could you speak to that a little bit?
Sure. Well, it's an interesting day to be talking about major shifts because not sure when this episode will air, but it's April 4th. Trump's just released all of his tariffs, and the stock market's going crazy, and everybody thinks that it's the end of the world. It might be the end for a few people's worlds, but not likely. It's just a disruption. It's just a shift, as you call it, and it's a bit of a technological shift to your point for the name of your podcast. So, although in real estate, it's actually fairly stable. That's the message I'm communicating to all of our investors. We don't see any disruption. One of our rules when investing is, whatever business your tenant is in, that you're in that business too. So we're constantly looking at external risks that will impact our tenant base and therefore impact one of our properties. And for the most part, most of our tenants are local people. We do all commercial property. We're talking about doctors and dentists and state farm agents and mortgage companies and stuff like that. And we're not talking about export-import companies or car dealerships and things like that. Beyond that, the biggest major shift going on in the real estate industry has to do with interest rates. Real estate and interest rates are inextricably combined. And it all began, real estate was in its heyday, and there's a whole generation of people who were getting into interest rates when they were all 3 and 4%. And I'm an old guy. I remember the 1980s and the misery index and double digit mortgage rates and stuff like that. And I remembered inflation too, and it really wasn't. And frankly, it's nobody's fault, how old you are. I mean, there's people that, that are under 40 years old that have never experienced inflation because it kind of went away at the beginning of the 2000s and midway through the 90s. The old guys are sitting around when the government starts pumping trillions of dollars into the economy during COVID, and we're like, all right, well, here comes the inflation. And then we were confused when the Fed chairman is saying, well, it's just transitory. Like, no, it's not. I mean, what business school did you go to? And when the government pumps in money, you get inflation. It's axiomatic, and so we maintain that's the most predictable cycle of inflation in human history. And it actually came on a little bit later than most of us would have expected. And I think the Fed should have started raising rates in the fourth quarter of 2020 because the economy was just going like crazy in most of the country. There were still some other states where they were still pretty locked down, and maybe it wasn't go as yet. All of that's to say that's the cycle we're in, and I think we're kind of at the end of that cycle that's impacting commercial real estate. We've had a few rate cuts. Very interestingly, the rate that's near and dear to every real estate investor is the 10-year treasury, because that's the rate that all banks base everything on. And it has not tracked with the Fed funds rate as it was. If you look at when they first started cutting back in September, yeah, it dropped and then it came back, came up. Then they cut again and they cut two more times and the 10 years just like, we ain't moving. Yeah, it has moved this week as the world thinks the economy is coming to an end. The other side of that is good old fashioned supply and demand. Now, we're talking about the yield on the 10-year, which is, the rate at which you earn on the moment you buy it. So the yield's actually been coming down, which means you earn less, and that means more people are buying that bond. And so people are leaving the equity markets and flooding into the treasuries and things like that. So it's a flight to safety. It's a fear response. This is all going to shake out. It's probably going to take a little bit longer than most people would hope. It's not going to shake out next week. I think we're going to see some stabilization come this summer. The equity markets will get some footing, and they'll continue to raise. Yeah, I don't think that the president is kidding. I've seen this in other reports that there are $7 trillion of investment coming into this country, largely in part due to the tariff action. That's like an entire year's federal budget, double. I mean, that's just a lot of money. It's going to have an impact and will likely impact every person on the planet. Because you're not going to have that much capital investment, purchases of land and buildings. I mean, just the construction jobs alone are unfathomable. So all of that's going to be really good for commercial real estate. As the economy goes, so goes real estate. Really, as housing goes, so goes the economy. So anyway, I could ramble on about all this kind of stuff. I'm not sure I'm actually addressing your question, but those are the big movements that I see in commercial real estate.
No, I think that was a great answer, right? You spoke a lot about what's happening now, which is really important because I think there's a ton of fear happening right now in the market because of the tariffs and different things going on with the interest rates. So people are making these moves to be more strategic and be safe. I think that, like you said, this is not something that's going to shake out immediately. It'll take some time. Maybe we can see deals get a bit leaner. So I want to ask you, as deal teams start to get leaner, how do you see technology playing a role in how firms are able to handle, the day-to-day tasks, whether that be due diligence or asset management or things of that nature, without sacrificing quality?
Yeah, actually a really good question. We're a small team. There's four of us, and one of them's part-time. So we couldn't have made the acquisitions that we've made. We certainly couldn't do the management without technology or PropTech, as it's called in the real estate world, because I can be in California and unlock somebody's storage unit as well as my team can do it remotely. There's so many things that you can just allow remote. I can rent a storage unit while I'm on the beach in South Alabama. Just sitting there, and it makes for a quality of life. It certainly is a force multiplier when it comes to having a small team, and I don't have to have somebody on property or even running around to meet them. There is no need to meet. Obviously, real estate is real. It's physical. You'd have to be on the property a lot, but you get to plan it far better than you would normally have expected, because the urgent things are more easily handled on a remote basis, if that makes any sense. So as far as on the acquisition side, there are databases that we can access to get certain data. I can work with a contract underwriter to help me work my model. And actually one I work with is in South Africa. He's an Excel wizard. He's some sort of a UK expat, lives down there. I don't know why. But he does great work, and he and I have a rapport. He knows how I like my underwriting models to be built, and he's really good at it. You can't do that without technology. We share a cloud. We share a Dropbox account. It's just a wonderful time to be alive. IBM they brought the personal computer onto the market while I was still a junior in college. It's like, so I've seen I've seen it all. I've seen the beginning and the end of fax technology. I thought that was the most amazing thing I'd ever seen. I was wrong.
Awesome, man. It sounds like you like you said, you've seen it all. You probably have a ton of experience with it. And I really like the way that you're leveraging it to be able to have a global team that is, as you mentioned, a small team, but a very powerful team as well. So that's awesome. Let me ask you, pivoting back to a little bit more on the real estate side, how have investor expectations evolved? And are you using anything technology-wise to improve how you report or communicate or raise capital?
Yeah, we use, and I think most deal sponsors are doing this, but we use a deal platform, which actually has every feature you need from beginning all the way to the end of a transaction. So it's a platform that in the beginning, when we're raising for the deal, it has a data room where somebody goes on, they create their profile, which you do even while you're trying to decide if you're going to invest or not. But setting up your account and your profile gives you access to the data room, and you can look at all the due diligence materials. You can look at the pitch deck. You can look at the contract. You can look at all the subscription documents from placement memorandums and things like that. When we get the inspection report on the property, that goes in there. So everything about the whole deal is just in there. And you know, investors are they're unique individuals. I'll say that. So I'd say about 40% of our investors actually will engage with the platform. The others, they just want to talk to me on the phone. That's okay. And I'll email them that document or whatever. And some of them are just say, yeah, just tell me where to sign. I mean, that's actually the greatest honor, but I always say you really need to go take a look at the due diligence materials. But the deal platform, and the one we use is called Syndication Pro. It just takes care of everything. So they register their bank account. So when we're making our quarterly distributions, it handles that. It calculates the waterfall, to each investor, and it just pulls the money out of our account and sends it directly to their bank. When we just did the K1s, for 2024 from all the partnerships. We put the K1s into their account. They're able to go in there, or most of them probably just give the logins to their accountants who download the K1s. And so it's just a great communication portal. Our monthly reports go in there so that they have they don't have to look it back up on the email. They can go there and find out the historical financials and whatever it was I said last month. Technology, again, back in the day, and I used to work for some merchant bankers and investment bankers back in the 90s. I mean, they'd have a staff of 25 people doing all that stuff. Word processing and desktop publishing were the buzzwords of the day, and they put out some pretty good looking stuff, but then it was still being stuffed in an envelope and mailed all over the place. So yeah, technology has definitely, like I say, force multiplier. It allows this tiny little team to look big and focus on important stuff.
Awesome. Awesome. I love that answer. So it sounds like, a ton of tools are working good for you and you're staying nimble. Can you tell me a little bit about what's going great and maybe some of the things that may be frustrating for you now?
Well, I hate software updates. They always come at the wrong time. And a lot of them are driven by operating system updates and things of that nature. And nobody, I would just say for the entire industry, nobody's, what do you call it, quality control or testing before they roll out an update. Nobody ever does it thoroughly enough. They rely upon their paid customers to find their bugs for them. And some of them are so common, you're just like, did y'all try it all? But, and that's just a frustrating factor. And I understand a lot of updates are related to fraud prevention, which is, the stuff we all have to go through because, somebody decides to be a hacker and either for fun or for profit, but those are the things we accept just because of the world we live in. I mean, you're foolish if you're not adopting top security. And I'm dealing with people's bank account numbers and social security numbers. And so we make sure that the platforms we use are also using and staying up to date on the best security and things like that. So, those are the frustrating ends of stuff. Other than that, sometimes, the internet just doesn't work. or their site is just down and stuff like
Mhm.
that. That's the downside. Now everybody's on the internet, and you live by the internet, you're going to die by the internet. But other than that, there's no other way to get business done at the speed and the volume that most of us are trying to do business these days.
I completely agree with you. That was a great answer. Everybody has their pet peeves about the tools that we use every day and things that bother us a bit. So thanks for sharing that. Let me ask, what metrics are you most focused on improving in Harvard Grace?
Right now, and we are in a bit of a lull and have been really since the first of the year, capital raising, and it's not just us, it's industry wide. Investors are on the sidelines, and they are, rightfully so. They don't know what's happening. The market's already taken a tumble, and those that would have liked to have pulled cash out want the market to come back a little bit because they don't want to realize the loss. And so it's a bit of a self-defeating cycle. Talked to a guy the other day that he's had it with this market. He wants to move to real estate, but he's in the same
Mhm.
place. He wants the market to come back a little bit before he makes that move, and I get that. So to our metrics, we're really working on um, cost of acquisition uh, per investor. Pretty much half of what I do every day is all about either content creation and which is directly related to capital raising and investor relations and expanding the number of people who get in the top of our funnel
Mhm.
and so that I can have conversations with them. We're having a little bit of traction in that. And of course, technology is involved in all of that,
Right.
be it digital ads or be it LinkedIn outreach or Facebook outreach and stuff like that, which is all very time consuming. It's all very nuanced and requires actually people who are experts at all that. I'm just like, hey, I just want to talk to people on the phone, and I don't have time to learn Facebook ads. And so we use partners for stuff like that. And actually using a pretty good one right now. Our key metric is number of new additions to our email list, as well as uh, the cost and time it gets to convert somebody into becoming an investor. We've got about 85 investors at the moment. I've probably got 250 people that we have some sort of a relationship with, either email or phone or both, that we hope will become investors. And so we're trying to move them through the funnel at different levels, at different speeds. And so we manage all of those and have metrics for all of those funnel levels.
Awesome. Awesome. I think that's definitely a great way to keep your finger on the pulse of where growth is and, keeping the engine running. So that's awesome to hear. So I know you spoke
I'm a
about,
CPA who's become a marketing person.
listen, marketing, we all have to do it at some point,
Yeah, we
right?
do. We do. Yeah.
Absolutely. So let me ask you about, you mentioned around the summer that you expect to maybe find the market to find some footing and people to start, feeling a bit more confident. What would you say you see for the next 6 or 12 months from now and where you'd like to be positioned?
Well, let me back up a little bit. So, when back during COVID, every story begins with COVID these days, but
Right.
it's just sort of marking time for our generation right now. But everybody was stay at home. Offices were dead.
Mhm.
Retail was dead. Um, Except down here in the South, where we all pretended like there was no pandemic, and nobody stayed home. They didn't go to work, but nobody stayed home. So, but because of that, became the great debt wall discussions, and from the financial media, that all of these office buildings and a lot of these retail buildings and, uh, you know, their debts were coming due because most commercial real estate's done on a 5-year balloon type basis. And so now we're at the 5-year mark, but really everybody's been predicting every quarter from the fall of 2022 on, well, the debt wall's coming. Get
Mhm.
ready. The banks and the borrowers have all been working pretty cooperatively together in doing what's been labeled the extend and pretend move, and it makes sense. Nobody wins if you just start dumping a bunch of property out there with all kinds of other property and everything goes for a fire sale. So the banks find a rate that the borrowers can pay. And so, most of these things are performing loans. So it's not like they've got to take action on them. But I'm beginning to see and a lot of this is just from a lack of capital. Investors have pulled back, sellers are in the market, the prices are getting better. So I think beginning in the second half of this year and going all throughout 2026, it's going to be a back up the truck and buy everything you can kind of a season. This will coincide with lower interest rates because I think the Fed will lower unless something drastic happens. And I don't think what's going on in the market is drastic. But unless the economy just really starts to slow down, I think the Fed will cut rates one more time this year, probably late third quarter, maybe fourth quarter. But then there will be a few more cuts next year. And then the other thing that people don't seem to want to talk about, they just want to gripe about, is all of this government spending cuts that's being done and is taking place, and buyouts and layoffs and stuff like that from government employees. The government's budget is going to get cut, and treasury rates are tied to the performance of government. Treasury rates will come down as well. And so you've got all of these sellers who need to sell with lower interest rates. And like I said, it's going to be a generational buying opportunity in real estate. Now, I like to talk about how old I am. I've seen two of these generational. This is probably the last one in my lifetime, at least before I'm slurping my dinner. So these things tend to come around every 20 years or so. But I just think it's going to be get the team ready, get your acquisition machine going. The investors should meet us there because they'll see it too. And you're just going to be able to buy some great assets at great properties and just milk them for cash flow for the next 10 or 15 years. And then if you're watching the cycles, you start to sell them at year 10 or 15 before that next 20-year cycle comes around, where there's a big downturn. I do think it's mostly going to be properties that are financed with floating rate debt, and not their fault. I don't think any time in history we've ever seen rates go up 5.5 points in less than a year. Really poor management in my thought. I think had the Fed started raising rates in the fourth quarter of 2020, they could have gone slower and they wouldn't have had to raise as much. But just me. Yeah.
Listen, I love that answer. You gave a ton of great insights and a ton of great information for us to digest. So I appreciate that. Last question. If you could solve one major challenge today, what would it be?
I wouldn't know how to solve this, but here is a systemic problem, and it affects homeowners as well as commercial real estate investors alike. So all real estate is local. We've all heard that. It's more true than most people could ever imagine, down to a simple intersection and why that corner of the intersection might be worth 2x than the other three corners. I mean, there's always kind of factors, and you really have to drill down into that. All real estate is local and it's hyperlocal. The problem with that is all financing is global. I'd get the same interest rate in Huntsville, Alabama, as I would in Denver, Colorado, because banks, kind of work in lockstep. They're all basing everything off the 10-year treasury. And I'm not saying they're wrong, for the way they're operating. It just is. And it seems to me that better deals ought to get better interest rates. More secure deals, and I wouldn't know how to fix that. But if I were king, I might set up regional feds or something like that set different rates. Probably really crazy to manage. And the Fed is a legacy organization that was started before technology as well, and just still kind of operates the same way. So not throwing bombs at them or anything. It's just as a buyer that focuses on a particular geography in one of the hottest spots in the world, and you've got a local bank that says, well, the Federal Reserve says we shouldn't be investing any more commercial real estate. Like, do they live here? I mean, Huntsville, Alabama is one of the hottest markets in the country and has been for 10 years. And it's due to a lot of different factors. why does Chicago's office woes have anything to do with me other than banks who put in 60 to 70% of the money? The only counter to that is there's almost always some bank that will work with you. There's always some bank that's hungry and wants to do more. So I guess that's the
Right.
counterbalance to the market.
Yeah, listen, I love that answer. I'd love to see the Fed become more modernized and use data and information to adjust for the localized businesses that real estate is to help with those investments. Thank you for that answer, Stuart. Thank you for joining me. You provided a ton of great insight. And would you like to provide any contact information where people can reach out to you, people can find you, things like that?
Thank you. Yeah, I will talk to people about real estate all day long, every day. So I really do genuinely invite anybody to reach out. The simplest way to get me is at harvardgrace.com. There you'll find my contact information, our office phone numbers. You'll find my Calendly link there so you can book some time with me and we'll talk real estate. So harvardgrace.com, it's spelled out right there. And I would love to hear from you.
All right, sounds great. And thank you for joining me here on the
Thank you for
Assets
having
and
me.
Algorithm podcast. Take care.